Hi, welcome to Invest Engine's education series, a space for both beginners and expert investors, where we'll explore the principles of investing as well as share insights into it. I'm Ramin, an investment coach and founder of the PensionCraft YouTube channel, and today we'll be exploring the world of gold exchange-traded funds, what they do, how they work, and reasons why people incorporate them into their investment portfolios. As always with videos on investment, bear in mind that your capital's at risk and nothing in this video should be construed as financial advice. It's purely education. Let's start with why investors buy gold. One of the primary reasons is safety. When stock markets fall sharply, as they did here in the global financial crisis, gold rallied. The red line shows the price of gold and the black line shows you the price of the US stock index, the S&P 500. The reason why gold rallies during stock market crashes is that investors view it as a safe haven investment and a safe store of value which they buy when they're scared. So by holding gold, you diversify your stocks and reduce your losses when these stock market sell-offs occur. Another reason why investors buy gold is to beat inflation. Here are returns on US stocks, bonds and gold since 1871. What you can see is that gold has beaten inflation over this period. If gold didn't beat inflation over the long term, then eventually it would become almost worthless. You can also see that stocks were much more effective at beating inflation over this period, a point that we'll come back to later. Now let's look at the factors which drive the price of gold. We've seen that inflation can drive the price of gold. Fear is another factor, albeit a short-term one, which drives the price of gold during periods of stock market turbulence. Physical demand for gold can also be a driver, and this is primarily driven by central banks, which buy large quantities of the commodity. Turning to negative factors, high interest rates are toxic for the price of gold. So if, say, interest rates are 5% for holding cash, then gold becomes less attractive because it has volatility, whereas cash has none. Also, gold generates no income. And the lack of income while holding gold is why it's sometimes called a wasting asset. Now, gold is priced in US dollars, and that means that when the dollar is strong, the price of gold goes down when measured in dollars. And as with any commodity, if the supply of gold increases, that would push down the price. Although gold supply does tend to be fairly steady because gold mines are spread globally, so that closure of one mine doesn't really threaten the global supply. Instead of buying gold directly and having to worry about where to store it, you can buy something called a physical gold fund. Physical gold funds pool investor capital and then invest it into gold, which is then stored in depositories. And because they do this for large amounts of gold, they can use the economies of scale to reduce these storage costs. Here are two examples of physical gold funds, in this case from the fund manager WisdomTree. As they say in the fact sheet for these funds, WisdomTree has a custodian, HSBC Bank in this case, which looks after their stores of gold. The custodian keeps track of each bar of gold so that it knows exactly who it belongs to, in this case to WisdomTree and indirectly to you. Furthermore, this gold is stored in a secure vault in London. By buying physical gold, the fund naturally tracks the price of gold. Here are the returns of the WisdomTree Core Physical Gold Fund denominated in US dollars, and that's displayed in light blue. Alongside that, you can see the price of physical gold in yellow, and you can see it's doing a very good job of tracking that price. If the value of gold increases by 1%, then the fund's value will also increase by 1%, minus any kind of fees. If the price of gold falls by 1%, similarly, the price of the fund will fall by 1%, again, minus the fees. Now that was the dollar-denominated version of the fund. On Invest Engine, you can buy the same fund denominated in pounds sterling. As a UK investor, that means that you get the price of gold overlaid with the strength of sterling versus the US dollar. If sterling strengthens versus the dollar, the value of the fund, GLDW, will fall. And that's because each dollar will buy less pounds. Conversely, if sterling weakens, the value of the fund would increase in sterling terms. If we compare two versions of the fund from WisdomTree, one of them is called GLDW. I remember this is sterling denominated because it starts with a G, just like GBP, and WGLD, which is denominated in US dollars. Notice that as sterling weakened versus the dollar, the sterling fund outperformed the one denominated in dollars. As UK investors, we think about the price of gold in sterling terms, and as we've seen, that can make a big difference to the return we receive. But we can also remove the currency risk by buying something called a currency hedged fund. Many gold funds will not be currency hedged. This means that as well as buying exposure to the price of gold, we're also buying exposure to this currency risk of sterling versus the US dollar, just as we saw for the GLDW fund. If you want to get exposure to the price of gold as if you'd bought it in US dollars, even though you're a UK sterling investor, then you can buy a currency hedged fund. And here are two examples of that shown on InvestEngine. As you can see, InvestEngine makes it very clear when a fund is sterling hedged. You can see that in the line underneath the name of the fund. Now, these funds contain a derivative which cancels out any currency movements. This will avoid your fund losing value if sterling strengthens versus the dollar. However, if sterling weakens versus the dollar, you won't benefit, as you would if you hadn't hedged. Another way of getting exposure to the price of gold is indirectly via the price of gold mining companies. If we search for gold on InvestEngine, but specify the search filter equities or stocks, this turns up 3 funds which contain gold mining companies. The share prices of gold miners are also linked to the price of gold, because if they sell gold and its price increases, they make greater profits. But there is a more subtle benefit here, which is that these companies pay dividends or income. While gold doesn't pay income, it's a wasting asset, these companies do. The drawback of this approach is that there are many other factors which drive the share prices of these companies. And that means that when global stock markets fall, so too will the value of these stocks. Pure gold is a better hedge against a global stock portfolio than the shares of gold mining companies. In summary then, the primary benefit of buying gold miners is that they pay a dividend. So while holding gold directly doesn't pay an income, holding the stocks of these gold miners does. Furthermore, stocks tend to beat inflation by more than gold does alone. So by holding these funds, you may get a greater capital gain over time. And the drawback with gold miners is that when stocks fall, they will too. So this isn't such a good hedge as holding gold alone. I hope this video has helped you understand why gold might have a place in your portfolio. Alongside bonds, gold has been used by generations of investors to hedge their stock portfolios. If you did enjoy this video, then don't forget to like and subscribe, and also check out the rest of this investment series from InvestEngine, and check out the website investengine.com.